What if banking didn't rely on interest, but on mutual trust and shared profit? Welcome to Islamic Finance Unboxed. We will explore the world of Mudarabah, a foundational principle in Islamic finance that promotes ethical investing, risk-sharing, and trust-based partnerships. In today's video, we'll uncover how Mudarabah works, how it differs from regular banking. What is Mudarabah and difference from Musharaka? In simple terms, Mudarabah is a partnership where one partner provides the capital and the other provides the proficiency in labor. The person or institution providing the money is called the Rab al-Mal, while the one managing the investment is the Mudarab. Here's how it works. The Rab al-Mal entrusts their funds to the Mudarab. The Mudarab uses these funds in business ventures that comply with Shariah. Profits are shared based on a pre-agreed ratio. If there is a loss, it is borne entirely by the Rab al-Mal unless negligence or misconduct by the Mudarab can be proven. The key principal rule is no guaranteed profit, no guaranteed return of capital. It's a genuine risk-sharing model that encourages real economic activity, not just financial speculation. Here is a summary of comparing Mudarabah and Musharaka. Mudarabah is a profit-sharing partnership where one party provides capital and the other provides expertise and management, Mudarab, with profits shared as agreed but losses borne only by the capital provider. Musharaka, on the other hand, is a joint venture where all partners contribute capital and may participate in management, sharing both profits and losses according to their investment ratio. In Mudarabah, the manager does not risk personal funds, while in Musharaka, all partners have their capital at stake. Mudarabah is ideal for passive investors supporting entrepreneurs, whereas Musharaka is more collaborative and often used for larger business ventures. How it resembles conventional banking. From the outside, Mudarabah might look like a typical banking interaction. One party, the depositor or investor, supply money. Another party, the bank or entrepreneur, uses that fund to generate income. The original party receives a return. This seems similar to deposit-based lending in regular banks. But there's a catch. In conventional banking, the return is predetermined as interest, regardless of whether the bank makes a profit or not. In Mudarabah, the return depends entirely on actual business performance. This aligns investor expectations with real-world outcomes, which makes it feel closer to venture capital than fixed-income banking. Key differences between Mudarabah and interest-based finance. Although Mudarabah and conventional banking may seem similar on the surface, both involve someone with capital entrusting it to a financial institution. However, they are fundamentally different. In conventional banking, the system turns around interest. When you deposit money, the bank promises you a fixed return regardless the bank profits or loses, your interest is guaranteed. This creates a system where profit is detached from real economic activity. In contrast, Mudarabah is built on a model of partnership and trust. Instead of guaranteeing returns, it requires both parties, the investor and the entrepreneur or manager, to agree in advance on how profits will be shared. The accurate return depends on the actual performance of the business. If the venture performed well, both sides win. If it fails without negligence, only the capital provider bears the financial loss, while the Mudarab loses time and effort but not money. This reflects a deeply ethical approach. You don't earn money just by having money. In Islamic finance, income must be tied to real economic activity and real risk. Money can't generate more money in a vacuum. Another important distinction lies in the handling of capital. In regular systems, capital is often deployed wherever the highest returns lie, even in speculative or high-risk sectors, so long as the interest is secure. In Mudarabah, however, the capital must be used strictly within Shariah-compliant activities, avoiding businesses like gambling, alcohol, or excessive uncertainty. How Mudarabah is used today. Many Islamic banks, participation banks, and institutions use Mudarabah contracts for investment accounts. Customers deposit money into profit-sharing accounts where the bank acts as the Mudarab. Private equity or startup investments. Wealthy investors can fund a business idea in a Mudarabah partnership. Microfinance and SME support. Risk-sharing for small businesses aligned with Islamic ethics. Banks like Al-Baraka, Bank Islam Malaysia, Mizan Bank, and others in the GCC and Southeast Asia have used Mudarabah-based savings and investment products for decades. In modern practice, banks act as aggregators of Mudarabah funds, pooling money from thousands of depositors, investing it across Shariah-compliant portfolios, and distributing profits accordingly. Market size and global trends. Islamic finance is growing fast. As of 2024, the global Islamic finance market stands at over $4 trillion, with banking forming nearly 70% of the total. Within this, Mudarabah-based contracts make up a substantial part of Islamic banking liabilities. Key markets. Malaysia. Mudarabah is a common mechanism in Islamic deposit accounts. Gulf Cooperation Council, GCC, used in investment accounts and real estate financing. Pakistan and Indonesia, growing implementation through Islamic microfinance models. In Turkey, a government opened 3 governmental Islamic banks, whose name is Participation Bank in Turkey, alongside 5 other private participation banks. The market size of participation banks reached out 8.5% of national banking sector. Newer fintech startups are even exploring digital Mudarabah platforms, where investors can directly fund small businesses and receive profit shares transparently. Despite regulation hurdles and varying Sharia interpretations, Mudarabah remains a vital tool in making Islamic finance both authentic and functional. Criticism and challenges. Mudarabah isn't without criticism. Here are a few key concerns. 1. Asymmetrical risk. The capital owner takes on all the financial risk, whereas the manager, Mudarabah, risks only their time and reputation. This can create tension if returns are lower than expected. If the capital owner has more money, he might be more capable of managing the business. The Mudarabah might be meaningful for businesses that require technical skills. 2. Profit rates mimic interest rates. In practice, profit expectations in Mudarabah often align with prevailing market interest rates, leading critics to say the difference is superficial. However, defenders argue the intention and risk structure remain fundamentally different. 3. Lack of transparency. If the Mudarabah doesn't report profits accurately, the capital owner could be misled. This risk demands strict auditing and transparency, which not all institutions enforce rigorously. 4. Regulatory gaps. Many countries lack unified Islamic finance laws, leading to inconsistency in Mudarabah implementation and enforcement. Still, scholars maintain that ethics, intention, and economic fairness differentiate Mudarabah from interest-bearing loans. Mudarabah may not replace traditional banking anytime soon, but it challenges us to rethink how money should work in society. With its roots in trust, partnership, and fairness, it stands as a beacon of what finance could be, not just what it is. What do you think about Mudarabah? Would you invest in a profit-sharing partnership? Like, comment, and subscribe to Islamic Finance Unboxed, your source for deep, clear, and practical Islamic financial knowledge. In the next video, we will take a closer look at the Mudarabah tool. It is the equivalent of trade credits in the world of Islamic finance and participation banking. We will cover its definition, pros and cons, and any criticisms. Don't miss this crucial explanatory video to gain a clearer understanding of Islamic finance. Let's think and navigate together in the knowledge universe.